Hello, everyone. It's Laura Scholes and Michael Kutch today on February 3rd, 2023 for this week's Friday Live. Michael Kutch, again, he's our in-house portfolio manager, and he's here every single week to talk about what's going on in the markets me this past week. And this week's a doozy. There's a lot going on, and Mike's going to wrap it up in an easy to understand way that we can all understand it. So, and then after Mike talks, we are going to talk a little bit about forecasting. So happy late Groundhog's Day. Phil was just forecasting that we're going to have 6 more weeks of winter, which is not cool, but we're going to talk about forecasting for retirement right after Mike talks. But again, before we get started, just to let everyone know, to remind everybody, these are not recommendations. These are just our personal opinions and ideas and stuff like that. If you ever want to talk to us about your own personal experiences or your own personal finances, please give us a call. All right, Mike. So what's been going on in the market?
Quite a bit. This week was like the Super Bowl for the financial industry. We had a Fed meeting, the January jobs numbers, ISM, and 4 FANG stocks reporting. So the market surged again this week following the Fed meeting. As anticipated, they did raise by 25 basis points to a range of 4.5 to 4.75. However, the big surprise to me was Powell fought every opportunity to be hawkish, and he had plenty of them. Now, he did say they need to continue raising rates and keep them elevated for a while. However, his demeanor was almost calm. He seemed pleased with the progress that they've gotten on inflation and really opened up the optionality going forward on their decisions. He pretty much said if the economic data, or specifically inflation, continues to go lower, maybe they won't go as high as initially anticipated, which is between 5 and 5.25, but also vice versa. So he really opened up that optionality. He got asked specifically about whether the easy financial conditions are making their job harder. And again, he took the more dovish stance and said they're more concerned about the longer term moves in financial assets than shorter ones. And they've seen significantly weaker financial conditions than about a year ago. So to me, this was him really putting a stamp of approval on the recent rally. He could have really, like he did in Jackson Hole, killed it, but he did not do that. So, for example, take today's market reaction, for example. We got the employment report, which added 517,000 to the payroll number, which is a ridiculously good number. The unemployment rate ticked down to 3.4%, which is a 49-year low. And we also got a hotter than expected PMI services number, while pretty much all the FANG stocks that reported last night came in pretty disappointing. So today could have easily been a 2.5 to 3% decline in the market. However, the S&P is barely down. Yeah, I think it's down about 0.25% right now. So now on the economic numbers that we got, there was some good news for the Fed. We saw a slight increase in the participation rate. Wages came in line with expectations. They didn't increase. And the prices paid component on the PMI services also showed further deceleration. So all those are good when it comes to the Fed rate hikes going forward. Now, on the S&P 500, we did get above the December highs, which confirms the breakout from this downtrend line that has been in place all of 2022. And I would say if the market closes today down less than 1% or 0.5% even, I don't see why this rally can't continue in the short term. Next resistance on the upside will be the August highs, which are around 4,300. And I think the trend in inflation should be favorable in the next couple of months to keep that trend going. Now, just to be clear, I know I'm sounding a little more positive today, but I'm not waving the all clear when it comes to the stock market and the economy. But in the near term, I think this rally has some further legs.
Well, and I think a lot of people don't understand that 4% of unemployment is technically full employment, right?
Yeah, I mean, historically, if you look back, say 40 years, I think the unemployment rate would probably be closer to 5%. We've just been in a very low unemployment rate environment over the last 10 years.
which is good. So I think everyone here has the same question. Phil said we're getting 6 more weeks of winter. Mike, what do you think is going to be going on in the next 6 weeks of the market?
I think Phil can come out of his hole for a little bit.
Yeah. All right, great. Well, thank you. So speaking of Phil in forecasting our weather, I decided to bring back a little technique. So, or not a calculation, I'm going to pull it up here. There we go. So the number one question that I think we get is, I could be meeting somebody at someone's birthday party or just someone out, a friend. And when I say I'm a financial advisor, the first question that usually comes out of their mouth is, cool, what's the amount of money that I need when I retire? And there's no really right answer. Brian here in our office always likes to say, well, if you give me the day you're going to die, I can tell you exactly how much you need every single month until then. However, we don't know when we're going to pass. So that number is different for everybody, but we can make pretty good assumptions. So I have an example for us. This is just an example, so please do not take this into consideration, these values, as anything that you guys need to do. If you want us to do a similar calculation for you, we can do that through our financial calculators or through our financial planning process called our DREAM process. And our R stands for reduce, all about reducing stress, becoming your CFO in your life so that you can retire and be completely stress-free and live the entire life. Okay. So in this example, we have a client who she is 41 years old. She makes about $80,000 a year, 80% of her current income through retirement. So her spending habits are going to be pretty similar in retirement that they are right now. We're assuming an inflation of 3% on her lifetime, an 8% investment return while she's working, but we're going to bump that down to 5% whenever she's in retirement because we don't want to be as aggressive. Now, she's telling us she wants to retire at 62 and she has great family history, so they think she's going to live about 95 years old. We typically live out or plan out for 90, but if someone has great family history, we can certainly plan beyond that. So with Social Security estimated about $1,750 a month, $21,000 a year, how in the world do we figure out all these moving parts and how much you actually need to retire? Now, one thing in this example, we're assuming at 41 years old, she has nothing saved, nothing at all, nothing for retirement, zip, nothing saved. So these numbers are going to be a little drastic. So 80% of 80,000 is about $64,000 a year. And then we'll subtract the estimated Social Security amounts, which was $21,000. So that leaves us with about $43,000 a year of expenses that we need to supplement. And that would be through investment accounts, your retirement accounts. So first, we have to inflate that $43,000 every year, 3% until she retires, and then continuing inflating that until she actually passes at age 95. Once we get that value, that's about $80,000 a year that she'll need in retirement in future dollars. Then you have to calculate that lump sum based on the return. In lump sum, she'll need about $1.9 million over her lifetime in retirement. Once you take that future value of $1.9 million, bring it back down to today's dollars, and including the 8% return while she's working, if you break that down on a monthly basis, she needs to save a little over $3,000 a month to continue her lifestyle. Now, this is an extreme case. Again, at 41 years old, you typically have retirement savings saved up, but we do see cases like this, and it just proves how important it is. She'd be spending $1.9 million in her. So save for retirement, save more than the match if you can. And then if you want something similar, we can do this for you in the office. Again, that was just an example. Don't take that into any consideration for your own personal finances. And then through that, we can then calculate through our financial planning software how much you can actually spend a month in the earliest year that you can retire. For 62, for this example, probably not going to work for her. But that's why planning for retirement early is so important.
It certainly is.
So yeah.
That was good information, Laura.
What was that?
I said that was good information. Thanks.
Yeah. So super, hard to calculate without financial planning. So to help, give us a like if you thought this was. We get about these specifically. Just comment below, or just give us a like, and we'll keep doing the topics that we've been doing. Or if you want to hear something different, just give us a comment. But in the meantime, 6 more weeks of winter. Bundle up and stay warm out there and enjoy your weekend, everybody.
Okay, bye.
Bye.